Good day and welcome to your daily news digest. Starting with market trends, analysts are pointing to history as a guide for 2026. According to one chief market strategist, bull markets that last 3 years, as the current one has, tend to extend significantly longer. Strong quarterly reports from major technology companies suggest the Nasdaq's rally is sustainable, pointing towards a potentially strong year ahead. Adding to that optimism, Nvidia CEO Jensen Huang says a revolutionary, artificial intelligence transition is on the horizon, which could unlock even more opportunities for the tech sector. While Nvidia has been a top performer, some investors are questioning if its run can continue into 2026 amid fears of an AI bubble. Meanwhile, some are asking if the next trillion-dollar AI opportunity might be in cybersecurity, not semiconductors. While chipmakers have been the early winners, the need to protect cloud platforms and websites from new threats could unlock a goldmine for cybersecurity firms, driving long-term outperformance in that sector. Turning to specific company analysis, retailing giant Walmart is being highlighted as a potential top value pick heading into 2026. Despite the rise of e-commerce, Walmart remains the world's largest company by sales and continues to grow. Its stock reflects this resilience, up 22% and outpacing the S&P 500, making it an attractive holding for value investors. In other blue-chip news, Amazon and the financial technology company Adyen are being called monster stocks to buy and hold for a decade due to their market leadership and significant room for future growth. Analysts are also looking favorably on Alphabet, the parent company of Google. Once seen as lagging in the AI race, perception has shifted, and it's now considered a top company for the AI era. One commentator even named it the single stock they would buy and hold above all others, citing its stability and long-term potential. Elsewhere, Taiwan Semiconductor is being called one of the smartest growth stocks to buy right now, given its critical role in producing the advanced chips powering the ongoing AI revolution. In the healthcare space, pharmaceutical giants Pfizer and Bristol Myers Squibb are being presented as two undervalued, high-quality companies for buy-and-hold investors. While both face headwinds, they have a proven track record of overcoming challenges. Pfizer is particularly noted for its high dividend yield, though some analysts caution that its high payout ratio may put pressure on its sustainability. Looking at potential turnarounds and value plays, health insurer Oscar Health is emerging as a compelling stock. The company is focused on the individual paying market and, despite facing rising costs today, is positioned with a strong long-term tailwind and is set to generate a profit again in 2026. In the semiconductor space, Intel is getting another look. Despite the stock being up roughly 90% on the year, it is still trading well below its all-time highs, with some analysts suggesting the recent market pullback has created a fresh buying opportunity. Tracking major investor moves, the Tulsa-based family office Schusterman Interests has been active. The firm acquired a new $148 million stake in Carmen Holdings, making it the fund's largest single position. The same firm also initiated a new $65 million position in medical technology company HeartFlow. In other news, hedge fund Stadium Capital made a potential turnaround bet by buying a $13 million stake in human resources firm Insperity, whose stock is down 55% from its highs. On the selling side, Stadium Capital completely exited its position in Grocery Outlet, selling its entire stake for an estimated $10.9 million as the stock continues a multi-year downtrend. The same fund also sold over 61,000 shares of software platform GitLab. Finally, New York-based Cooper Creek Partners sold a significant portion of its holdings in Signet Jewelers, a notable move given that the jeweler had recently lifted its outlook for 2026. For those building their portfolios, one strategy highlighted is using an exchange-traded fund, or ETF, to track the Nasdaq 100 index. This offers an easy way to gain exposure to the top 100 non-financial stocks on the exchange, serving as a popular option for growth investors aiming to build a substantial retirement portfolio. For income-focused investors, a comparison between two Vanguard dividend ETFs notes that one is more growth-oriented with a tech tilt, while the other favors higher yields from defensive sectors, offering different paths to generating passive income. That's all for today. Thank you for listening. Goodbye.